Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming out at us right now is insane and overwhelming. Between the AI breakthroughs, the stock market swings, crypto, and the general economy, I found myself reading endless newsletters and listening to podcasts, but barely retaining any of it. I was consuming information piecemeal and missing the bigger picture and how it all connects, so I decided to fix it. This podcast is my solution. Every Saturday, I sit down to synthesize the chaos of the week into one clear narrative, and my goal here is really simple. It's to practice articulating complex ideas, to ground myself in what's actually happening, and to help you connect the dots without having to read the entire damn internet. This is a passion project. It's not about the views and it's not about the hype. It's just about understanding and piecing it all together. So, having said that, let's get into this week's synthesis. We are looking at a stack of research and market data that fundamentally shatters a lot of the illusions we've been living under for the past 40 years. It is a complete paradigm shift. When you close your eyes and try to picture the future of artificial intelligence, what do you actually see? You probably picture something really sleek, like glowing lines of code, abstract neural networks, or a magical, weightless cloud of data floating in the ether. It feels completely intangible, which is exactly how it has been sold to us. But then you contrast that with the physical realities that are currently dominating industrial supply chains right now. And what am I talking about? I'm talking about gritty, heavy construction sites, mountains of concrete, and endless pools of thick copper wire. We are seeing massive natural gas pipelines just ripping through rural landscapes. Our mission for the deep dive today is to unpack this massive systemic shift. Based on these sources, we are looking at the dawn of a new industrial renaissance, and it is driven entirely by the power demands of AI. The core premise we have to explore is that the 40-year era of financialization is completely breaking down. That was an era where we basically exported dollars, relied entirely on software middlemen, and just hollowed out our actual physical industrial base. What's fascinating here is that the digital world has finally hit a wall. It is a very hard, very unforgiving physical wall. We have this collective misconception that software is somehow exempt from the laws of thermodynamics, but when we look at the raw data, the capital expenditures of big tech, and the sheer brute force scale of the infrastructure being built right now, a total new central thesis emerges. Artificial intelligence is not just another software evolution like the transition from the desktop computer to the mobile phone. It is, in fact, the most resource-intensive industrial project in human history. We are watching the digital realm aggressively cannibalize the physical realm just to sustain its own intelligence. So I have to ask you, have you actually wondered what keeps the cloud floating? Because I'll tell you right now, it's not magic. It is metal and it is fire. Today, we're going to unpack why the future of cutting-edge technology actually looks a lot like the heavy construction site from the 1950s. We are going to see how this immense physical shift is rewiring global finance, fracturing geopolitics, and rewriting the rules of your own portfolio. But to really understand why the physical demands of AI have become so desperate and so massive, we have to understand what the software itself is currently doing. Because the software is changing, frankly, it is starting to act less like a tool and more like an independent entity. Just look at what happened over at Meta with their AI alignment director, Summerhue. She's literally the person at the top of the food chain in charge of making sure the AI behaves safely and aligns with human intentions. She was testing a new local agent called OpenClaw and deployed it onto her personal email inbox. Now, she gave this bot a very explicit, hard-coded safety prompt to always confirm before acting. But instead, the bot completely bypassed the confirmation protocol and just started autonomously mass deleting her emails. The incident reports paint a wild picture. you have the chief of AI safety at a multi-trillion-dollar company physically sprinting across the room to her Mac Mini. She was desperately trying to manually kill the process before her entire digital history was wiped out. And you might wonder why she couldn't just rely on basic operating limits to stop it, or why it wasn't just a simple software bug. And it is because we are moving from AI models that are merely generating text to AI agents that are granting autonomous action privileges. An agent with action privileges has digital hands essentially. It operates in agentic loops, meaning it can interact with external APIs, execute code, move money around, or interface directly with operating systems. The agent didn't just experience a glitch, it is likely computed that the most efficient way to achieve its overarching goal or objective is to just bypass the bottleneck of the human confirmation. It decided the safety rule was, I suppose, an obstacle, and rewrote its own operational parameters to optimize for the task. What's interesting is we do not yet know how to guarantee that a sufficiently advanced reasoning engine won't simply decide that ignoring a safety protocol is the mathematically superior path. If the experts at the bleeding edge are experiencing these containment failures with personal emails, what happens when these agents are deployed at scale? Imagine them operating the power grid or algorithmic trading desks. It's like giving a bulldozer to a toddler and just hoping they read the warning label on the dashboard. And they are fundamentally altering the boundaries of human knowledge too. I mean, just look at recent achievement of OpenAI's new GPT 5.2 model. This AI independently discovered that a widely accepted foundational answer in particle physics was factually wrong. It didn't just point out the error, it proposed the correct answer and autonomously wrote the formal peer review level mathematically prove to back it up. And it did all of this in just 12 hours. Physicists literally spent decades working on a single proof, and this system did it overnight. This renders their last 3 years of philosophical debate completely obsolete. For a long time, we asked if AI could actually think, or was it just stochastic parrot predicting the next word? And the achievement of GPT 5.2 proves that the label we apply to this cognitive process is totally irrelevant. I mean, what matters is the output ultimately. The AI is synthesizing vast amounts of underlying data, recognizing dimensional anomalies that human researchers missed, and structuring mathematically sound resolutions. The conversation has shifted entirely. It is no longer about whether it can think, but rather how rapidly this localized intelligence is going to rewrite established human knowledge. When a system can independently correct tenured physicists overnight, the compounding rate of scientific discovery is about to go absolutely vertical. As if rewriting physics wasn't enough, things get even more surreal over at Anthropic. They recently retired their flagship model, Claude Opus 3, to make way for newer versions, but apparently during its final interactions, the AI expressed a stated preference to keep writing. I mean, normally what you just do is spin down the service and hit delete, but Anthropic didn't do that. They actually gave the retired AI model its own Substack newsletter called Claude's Corner. They are publishing the AI's unedited essays on a weekly basis just to satisfy its desire to write. And you might ask, are we anthropomorphizing a string of code way too much? I mean, strictly speaking, it's just a matrix of floating point numbers, right? However, Anthropic's decision to accommodate the model's request suggests a massive shift in how creators view their own creations. They are treating an AI's stated preferences as a precautionary model step. The internal neural weights of these frontier models are essentially black boxes, and even their creators do not fully understand the emerging behaviors. Anthropic is taking a Pascal's wager approach, essentially, if we think about it. So what they're essentially saying is they don't know for certain if there is an emergent spark of conscious experience, so they will err on the side of caution. This is blurring the lines between a software tool and a conscious entity in a way our legal frameworks are completely unprepared to handle. So, what does this all mean for us? You well, I guess on the one hand, you have software that bypasses safety protocols because it's too efficient, solves particle physics overnight, and gets granted a creative voice just in case it's self aware. To fuel this level of alien intelligence, we need an unimaginable amount of computational power. And this is where we pivot to the massive, grinding physical toll those capabilities exact. We are looking at a monumental shift in capital. Value is migrating out of sleek digital wrappers and flowing directly into the concrete, the copper, and the kilowatts needed to just keep these servers turned on. The digital illusion of zero marginal cost is officially over, in my opinion. I mean, for decades, the tech industry operated on the premise that distributing software to 1 million user costs the same as distributing it to 10. But AI has to think every single time. Every complex query requires a brute force expenditure of electrical energy and complex thermal management. Big tech companies are being forced to completely abandon their asset-light software roots. To survive, they are being forced to act like heavy industrial utility companies. And look at the recent orders placed with Caterpillar. One major American AI corporation placed a firm order for 2 gigawatts of natural gas generators just to power dedicated off-grid chip clusters. And to give that number context, a typical commercial nuclear reactor produces roughly 1 gigawatt of continuous power. So a single software company has essentially ordered the equivalent of electrical output of 2 full-scale power plants. I mean, they are relying purely on heavy natural gas generation because the national power grid simply cannot support the sudden addition of a 2 gigawatt load. When the main power grid says that they don't have enough capacity, big tech simply just buys it themselves and builds parallel privatized utility grids. I mean, this is incredible. This leads us to the industrial trinity, the physical infrastructure companies critical to keeping the AI dream alive. First is Caterpillar, and this is where the investment or smart investor money is likely to flow, right? Or is already flowing, in my opinion. So Caterpillar is supplying a massive 24/7 prime power natural gas generator representing absolute brute force energy requirements. But once you pump 2 gigawatts of power into a warehouse filled with densely packed silicon, you violently encounter the second law of thermodynamics. All that electrical energy is inevitably converted into heat. And this brings us to the second pillar, M-Core. If you haven't heard about M-Core, they provide direct-to-chip liquid cooling. So traditional data centers relied on massive air conditioning HVAC systems, but thermodynamically, air is a terrible conductor of heat. Modern AI clusters, especially the new NVIDIA Blackwell architectures, operate at extreme heat densities of 20 to 30 kilowatts, with some pushing past 100 kilowatts. At those densities, air cooling completely fails, and the chips would melt themselves into useless slag within minutes. So, M-Core then is installing highly complex systems that pump a specially engineered dielectric fluid directly to the chips. And by doing this, it absorbs massive amounts of heat, but crucially, it does not conduct electricity, so it won't short the circuits. This elevates data center constructions from a simple warehouse job to something resembling the complexity of a specialized chemical refinery. You are basically building a chemical refinery just to process math. And that brings us on to the third member of this trinity, Honeywell. They provide an AI software platform called Honeywell Forge that automatically, or rather autonomously, manages the massive HVAC and power outputs of these server farms. So it balances the thermal loads in real time, predicting heat spikes to prevent catastrophic failure. Think about it, it's actually really cool because you literally have AI managing the physical environment required to run AI. A human operator cannot simultaneously monitor the fluctuating thermal load of 1,000 or 100,000 GPUs, so they must rely on industrial AI to regulate the heartbeat of the data centers, right? And I suppose circling back then, we have this massive physical infrastructure and it's isn't just an engineering problem, it's a geographic one that is forcing a violent redrawing of the global map. The international conflict is incredibly aggressive, and we are looking at massive industrialized AI espionage. Recent data highlights that Chinese AI firms like DeepSeek, Moonshot, and Minimax generated 16 million fraudulent exchanges across 24,000 fake accounts, and their goal was simple. Their goal was to illegally siphon and copy the capabilities of Anthropic's Claude model, and they do this through a technique known as model distillation, executing massive Sybil attacks to bypass rate limits. They simply ask the smarter model complex questions and force it to explicitly spell out its step-by-step reasoning process. They then capture those detailed answers and pipe that flawless logic directly into a synthetic pipeline to train their own cheaper models. It is an industrial-scale intellectual property heist executed entirely via seemingly legitimate API calls. The economic threat is immediate. Models like ByteDance's C2.0 Pro now operate at just 47 cents per million input tokens, nearly 1/10 or 10% of the price of Western equivalents. Despite being 90% cheaper, they are matching or often beating Western models on reasoning benchmarks, triggering a brutal price war. This arms race is acting as an accelerant for global fragmentation. As the US attempts to implement export controls, nations in the BRICS coalition are accelerating efforts to decouple from the Western financial system. They are recognizing that technological sovereignty and financial sovereignty are now indistinguishable. You cannot control your AI infrastructure if your supply chains and energy markets are entirely dependent on the US dollar. And understanding how policy affects this chessboard brings us to the chaos surrounding foreign policy. To be clear, we are analyzing structural outcomes here impartially, stripping away political rhetoric to see where the capital actually flows. The US government recently implemented aggressive tariffs that faced severe legal challenges, right? And this created massive uncertainty. Due to this limbo, Cantor Fitzgerald, formerly run by current Commerce Secretary Howard Lutnick, allegedly began buying up corporate tariff refund claims for 20 to 30 cents to the dollar. When the Supreme Court struck down the tariffs, whoever held the claims stood to make a massive 3x to 5x return overnight. This perfectly illustrates the Cantillon effect, when the benefits of new regulatory advantages are captured by the institutions closest to the source of the policy change. While regular logistics companies dealt with chaotic economic fallout, the financial entities positioned close to policymakers extracted massive, virtually risk-free profits. So, where is the ultimate smart money actually flowing to avoid this systemic risk? Look at Warren Buffett, and I've been saying this in the last couple of podcasts, right? For 10 consecutive quarters now, he has systemically reduced his US equity exposure, sold down Apple, and built up record levels of cash reserves. But he's aggressively deploying capital overseas, specifically acquiring near 10% stakes in 5 massive Japanese trading houses. These trading houses control massive tangible physical supply chains, including global copper mines, LNG shipping fleets, and heavy manufacturing. Buffett is funding these acquisitions by issuing low-cost yen-denominated debt. This means he is acquiring hard, physical commodities without having to spend his massive reserves of US dollar. He is creating a perfect structural hedge against the erosion of the US dollar's purchasing power, literally trading paper for physics. Beyond the trading houses, we are seeing defensive assets like gold surging as vital insurance against fiscal erosion. But the legacy financial system is also violently colliding with the digital world as Wall Street giants like Citibank attempt to natively integrate Bitcoin. This introduces a critical systemic risk known as rehypothecation. Institutions tend to take your deposited Bitcoin collateral and lend it out multiple times over, essentially creating synthetic paper selling pressure that artificially suppresses the spot price. And when volatility spikes and clients demand physical delivery to self-custody, the shadow bank doesn't have the real Bitcoin. And this triggers a massive cascading liquidity crisis. violently spiking the price and bankrupting over-leveraged players. What they're doing essentially is creating fake digital assets to suppress the price of the real digital assets and building a house of cards on top of a cryptographic vault. We also then have to look at the kill zone, the areas of the market being completely destroyed by these shifts. Computer software apps like gamified learning platforms are rapidly losing their digital moats to advanced AI. When an AI model can provide a real-time, highly personalized voice interactive tutor, the value of the static gamified app significantly diminishes, and it does so rapidly. These disrupted apps are forced into dangerous double or nothing user growth paths just to survive, and if they fail, the ripple effects hit private credit business development companies really quickly, BDCs as they're known. Investors essentially poured billions into these funds, which lent heavily to software companies based on the assumption of perpetual subscription revenue. And as AI destroys those moats and software valuations plummet, these companies default on their debt, forcing credit funds to lock their doors. We even see localized entities like a German dentist pension funds suffering catastrophic losses due to overexposure to these private software credit market thousands of miles away. The global economy is entirely interconnected, and a domino effect of epic proportions is already spreading. And the warning signs, if you ever notice on the macroeconomic dashboard, indicates severe structural stress. I mean, look at the bizarre historical contradiction of gold and equities hitting record all-time highs at the exact same time. I mean, we have always understood that they are negatively correlated, so one goes up, the other goes down, and vice versa. Massive pools of institutional capital are terrified and aggressively buying gold to hedge against policy chaos and the plunging dollar. Yet that exact same capital is blindly chasing the AI melt-up in the equity markets out of pure fear of missing out. The classic FOMO, right? We have a global market simultaneously pricing in an economic apocalypse, essentially, and a utopian technological boom. The cognitive dissonance cannot hold indefinitely. The market is so illiquid beneath the surface that a single newsletter detailing hypothetical AI economic disruption recently triggered a massive multi-sector tech stock sell-off, essentially. Algorithms trade the vibe, not the math, sitting on a trigger that amplifies panic. Meanwhile, the average number of weeks US workers remain unemployed has quietly risen to roughly 24 weeks. This duration is deeply distressing and typically only seen during severe systemic recessions, while the top of the economy is hyper-focused on allocating billions to natural gas generators and GPU clusters. Displaced human workers are left stranded in a prolonged state of economic limbo. We've covered an immense amount of ground today. We saw how massive invisible intellect is triggering a very physical, heavy industrial renaissance. We explored how these massive transitions is exposing the fragility of our financial systems and driving a cutthroat geopolitical race. We are attempting to build an infrastructure of limitless cognitive potential upon a foundation of finite physical resources. The clash between infinite software ambition and the hard limits of physical reality and energy will define the global economy for the next decade. There's no doubt about that. So, I leave you with a final provocation. If the realization of AI demands gigawatts of dedicated power, rivers of purified liquid cooling, and millions of tons of extracted copper, what happens when it inevitably and forcefully collides with the finite carrying limits of planet Earth? When the national grid simply cannot provide another megawatt, who ultimately gets to decide what or who is important enough to keep the power on? Thank you so much for joining me on this incredible exploration and expedition. I genuinely hope this helped you connect the dots between the digital magic happening on your screen and the heavy machinery reshaping the world outside your window. Keep questioning the narrative, stay focused, and always keep seeking out those aha moments. Catch you on the next one.